Hello everyone, it's 4 o'clock, so we will make a start. So welcome to you all to our first webinar. We're going to be talking you through everything you need to consider when you're becoming a self-employed member of a law firm LLP. So just a quick introduction. My name's Sonia Fisher. I'm a partner in our legal sector team, looking after many law firms. And I'm joined today by Mike Furniss, a senior chartered financial planner in our financial planning team, and he's going to pick up and cover some various aspects that he'd be able to help you with. He's picking that up at the end. So it'll be myself and Mike today. If you've got any questions, do feel free to raise them during the presentation by using the Q&A section at the side there. We probably will pick up and answer the questions at the end if that's okay, but we can at least keep an eye on what's being posted in the Q&A. So I will kick off and run you through the agenda. I will just warn you, there is a lot to cover today and there's quite a lot of information. So don't worry if you don't take it all in. We do have a helpful handout on this that we'll be sharing afterwards as well that will kind of help bring it all together. But I do plan to try and cover the member status, so what it means to change from being an employee to a member of a law firm, and how your income will then get taxed. It's all quite different. I'll talk you through why you need to make an investment into the LLP, how that number's calculated and why that's there. Go to some of the legal bit, the bit you're more familiar with. I'll talk you through a members agreement and what you need to understand within that before you go ahead and sign that one. And then some important bits at the end, a lot more options around tax planning once you're a member and you're taxed as a self-employed person. So I'll talk you through various bits there and then hand over to Mike at the end to cover off understanding the financial risks that you as new partners will face. So I will just say before I go, I will at times refer to members and I will at times refer to partners. So ultimately it's the same. If you've got an LLP, you're known as a member. If it's a partnership, you're known as a partner. But I might kind of accidentally flip between the two, but I do kind of mean the same thing. So we'll make a start and look at the member status and kind of your tax responsibilities now that you're a member. So upon becoming an LLP member, you transition from the employee status to becoming self-employed. So there's a lot of practical implications to this. So you're no longer going to receive a monthly salary. And under your salary, you're taxed automatically, all deducted at source, and you never have to think about that side. Instead, as a member, you're going to receive drawings, and that's your way of being advanced your profit share. You're taxed annually, and that's all via self-assessment. So we'll get into some of the detail around that. So as a member, you're responsible for registering as self-employed with HMRC. And you need to do this by the 5th of October of the following year once you become a member. But I would always say as soon as you become self-employed, it's sensible to make that application for self-assessment with HMRC, and we can guide you through that. And it's all done online and fairly straightforward, if anything's ever straightforward with the revenue, that is. And then what you'll need to do once you're registered is you'll complete an annual self-assessment tax return, and you pay your tax and your NI directly to HMRC rather than it being deducted via your payroll. Your benefits will change and your rights. So your pension contributions that were made under your employer scheme, that will all cease. And if you want to have a pension, which obviously Mike will advise you to, then you need to arrange that personally going forward, and we'll talk you through that. If you were participated in various employer provided schemes, such as maybe a car plan, then obviously all that's going to cease when you are no longer an employee. All your employment rights no longer apply. So there's various statutory rights that would have applied when you were an employee. That all changes, and instead it's covered by your members agreement. And as I said, I've got a section where I'll talk you through that. But it's really critical that you kind of understand what protection and obligations you've got under your members agreement, and we'll cover that. So I mentioned you need to file your tax returns. So yes, you have an obligation to complete a tax return each year, and this must be filed online now with HMRC by the 31st of January deadline. So for example, the tax year to 5th of April 2026, tax year that's coming up, you need to file that one by 31st of January 2027. And finally, that shift to self-assessment does bring some challenges around timings on paying your tax, because rather than, as I said, paying that monthly, it's now paid twice a year on a July and a January date, and I'll talk you through that. So you need to manage those tax payments. And in the year you first become self-employed, that is quite a chunky first payment you have to make. But don't panic. Most law firms do have a tax provision and a tax reserve. So they help you with your tax payments and generally hold the money back and make your payments on your behalf. But I'll talk you through all of that as we get to that bit. So we'll move into some of the detail now. And look at how you are going to be taxed on your profit. So obviously you get a profit share as a member. So the LLP prepares a set of accounts each year and you get a profit share from those accounts. So under the self-assessment regime, your taxable income is based on your share of the LLP's taxable profits for each relevant tax year. So, and a tax year will always run from the 6th of April to the 5th of April. So I've got an example on there. The one that we're currently in at the moment started on the 6th of April 2025 and finishes on the 5th of April 2026. And the terminology that you'll hear a lot is that tax year would be referred to as 25-26 tax year. So that means it ends on 5th of April 2026. So I'll refer to that a bit as we go. Now, if you've got a 31st of March accounting year end, then that's quite simple for you to understand how you're going to get taxed on those profits, because although it's not quite in line with the tax year, it's 5 days different, the revenue do give a bit of leeway there, and all of your accounting profits will be taxed in the same tax year. So year end 31st March 2026, all of those profits will be taxed in the 25-26 tax year. Nice and simple. Now, if you've got an accounting year that's not 31st of March, then you'll get taxed still on 12 months of profit, but it might be 12 months from different accounting years. So if I say how it works from an accounting year, we've got a 30th of April year, really common year end for a law firm. So 30th of April 2026. 11/12 of that, I'm talking in simple at the moment, I'm keeping it to months just so we can understand, 11 months of that, so up to the 5th of April 2026, will be taxed in your 25-26 tax year. And then that final month, that last little chunk, April 26, falls into the 26-27 tax year. Just make that clearer. If we then got June year end, you're going to have 9/12 of that, so up to 5th of April 26. All of that's taxed in 25-26, and then those remaining 3 years, April, May, June, all taxed in the following tax year. So like I say, it's always 12 months of income, but it might be being pulled from 2 different accounting years if your LLP doesn't have a March year end. I've made a little note down the bottom because the revenue don't do it on whole months, they do it on the number of days. But rather than me having put 340 days on there or 25 days, I thought it was a bit easier to see when you're doing it in 11/12 and 1/12. So that's how it's calculated. So if we then look at how that's then reported onto your tax return. So I've got an example here where in a member's first tax return, you may have some salaried income up to the date that you're appointed. And then after that, you've got your profit share that you're getting as a member after that date. So again, if you're a March year end, this is a bit simpler for you to understand. It's likely that you're going to have been appointed as a member at the start of an accounts year, so 1st of April 2026. So all your salary up to that point, so we're April 26, all your salary up to that point will have gone through payroll in 25-26, and you don't need to put anything on a tax return for that year. Nice and simple. And then you've got a whole year of partnership profit share being taxed in the following tax year, the 26-27, because you were a nice simple start date of 1st of April. So a whole year through your payroll, and then a nice clear cut-off, and going forward, it's always a year on your tax return. If, for example, you were April year end and you were appointed as a member on the 1st of May, you've got a slightly more complicated first year on your tax return because you need to put your salary on the tax return from the 6th of April to the 30th of April. So in effect, that first month. So that's the last month of your salary, and that goes onto your tax return. And then you'll have 11 months worth of your partnership profit share also going on the same tax return. So again, 12 months of income, but 1 month for salary and 11 months for your partnership. the salary has already been taxed at source, so it doesn't get taxed again, but we do still need to put it on your tax return. So it's really important actually to remember, if you're appointed partway through the year, to keep your P45, because that will be needed by your tax advisor to put the detail onto your tax return. So that's just to explain kind of how your income and your profits are reported in the first couple of years as a partner. Quite just get the concept between your accounting year end and a tax year end. Hopefully that makes sense, but seeing those numbers there will hopefully help explain that. And then we need to consider how those taxable profits are determined. So when you get the LLP accounts, you'll get a profit share based on the accounting profit. So if a law firm has made £1 million and you get 1/10 of that as your profit share, then your profit share is 100,000. But just to make it a bit more complicated, that's not necessarily what you get taxed on, because we need to make some adjustments to the accounting profit to get down to your taxable profit, the profit that you are taxed on your tax return. So there's a few expenses that might go through the accounts of the LLP that are not allowable for tax. So most expenses are, so when the LLP pays for rent, utilities, all sorts of bits and pieces, you get the tax relief for that. There's certain things that they deem to be disallowable for tax purposes. Client entertainment's one. If you put through all motor expenses and some of that's got private elements to it, that would be disallowed. So we have to do an adjustment. This is called a tax computation. So we take your accounting profit, we add back those disallowable expenses. We then have to make some adjustments for capital items. So to go back to basics, a capitalized item in your accounts is something tangible. It's your computers, it's your desks, your chairs, it's the tangible items. So you don't get tax relief in quite the same way on them. In the accounts, they get capitalized and then written off through the P&L with something called depreciation. You don't get the tax relief on the depreciation, so we add that back. Instead, you get capital allowances as a way of getting tax relief on capital items. So if you buy some computers, you get your capital allowances on that. And the rules are quite generous around that at the moment, because they're encouraging businesses to invest. So you get a first year allowance on that. So if you spent £2,000 on a computer, you're likely to get that full relief in the first year. So we have to do some adjustments. So I don't want to get too techie on you, but we just have to do some adjustments. So your accounting profit is quite often different to your taxable profit. So you might look, when you get your first set of accounts and your first tax return, you might wonder why the two numbers aren't the same, and you need to ask for the tax computation to understand why there's some differences. They don't tend to be huge differences, but often your taxable profit is a little bit higher than your accounting profit due to the add backs of the disallowables. I've then put a little note on the bottom of this slide just to talk about fixed share members and equity members. So I know we're in the depths of how you're going to be taxed, but I might just step back at this point and just talk you through the difference between a fixed share member and an equity member. And this won't apply to all law firms, because some firms won't have fixed share members. You'll just all be equity members, and it's quite straightforward, as in you're taxed in the same way. But many firms will have fixed share members, which is kind of almost a stepping stone to getting up to equity members. So fixed share members do have capital in the business, but much lower amounts of capital, and I'll talk you through that in a minute. They have limited voting rights, and they tend to get fixed profit shares, hence the term fixed share members. Whereas equity members, they're the owners of the business. They're the ones with the real capital stake in the business. They're the ones that will make the key voting decisions and have the higher voting powers. And obviously, as a result of that, they get a higher return on their investment in the business. They get profit share, which is often as a percentage of the profit, as opposed to kind of a fixed amount. So a fixed share member, because their share is fixed, often their taxable profit isn't adjusted for all of these add backs. So for a fixed share member, you might get a fixed share accounting profit share of 100, and actually that might be what makes it onto your tax return, because you don't get these adjustments for the add backs and the capital allowances. Whereas for the equity members, they're the ones that have these adjustments flow through to get to their taxable profit. So slightly trickier for them to understand how their taxable profit relates back to the accounting profit. But it just it's helpful for you to understand that those two numbers aren't the same. You don't get taxed on exactly what your profit share is due to some adjustments we need to get for the figure that goes on your tax return. So if we move on and look at what tax rates are going to apply to that income. So we've now talked through how that income is calculated and how it comes from the accounts and onto your tax return. So now we've got some income, some taxable income. How's that going to get taxed? What tax rates are going to apply? The tax rates follow the standard UK income tax thresholds. And actually, these are the same for you as a self-employed member as they were when you were paid through payroll and just got the salary. So you're still entitled, subject to certain thresholds, you're still entitled to your personal allowance. So the first 12,000 of income is tax-free. And then the next chunk up to just over 50,000 is taxed at 20%. And then the next chunk up to 40%. And then anything over 125 is taxed at 45%. There are some slightly higher rates coming in for savings and property income, as announced in the latest budget. So for those types of income, and you do get some interest income because you get client interest income, some of that will be at 22, 42 and 47. But let's not make it too techy here. Let's stick with 20, 40 and 45. But what's important to point out here is that there are some really key thresholds that you need to be aware of. And it's helpful to do some tax planning to avoid falling into certain bands. So if your income is below 100,000, you retain your personal allowance, so you get that tax-free amount. And if you've got young children, you might very well be claiming tax-free childcare and getting your 30 hours of free childcare. Now, when you creep over the £100,000 threshold for your income, you start to lose some of this. So for every £2 over that 100,000, you lose £1 of your personal allowance. So by the time your income hits 125,140, you've lost all of your personal allowance. Now, if you think about it, that income in that bracket, that income from 100 to 125, because you're losing that tax-free bit, that personal allowance, that bit of income is getting taxed at an effective rate of 60%. Really, really painful band to be in, and you want to avoid that. Not only do you start to lose your personal allowance, but if you tip over that 100k threshold, even by £1, you lose your free childcare and that tax-free childcare. So you can do some clever planning around that, and we'll pick that up in a minute. But if you make some pension contributions or make some gift day donations, that increases those thresholds. So for example, make a 10k pension contribution, that threshold goes up to 110. So you could actually earn £110,000 before you start losing your personal allowance, or you lose your tax-free childcare. And I have seen a member of a law firm actually turn down an extra bit of profit share that was going to be allocated to them because it tipped them just over the 100 and they didn't want to lose their free childcare. So they said, actually, give this to me. I'm actually going to be worse off if I take this extra 2k of profit. So that's a really important band to think of and to talk with your tax advisor and try and plan around avoiding that level. And also, once your income goes over 125,000, you start getting taxed at 45%, that additional rate. So actually, you either want to be below 100 or quite significantly above it, because there's a horrible bit in the middle where the effective tax rate and some of the other benefits you lose are quite painful. It's quite tricky though, because you do need to make those pension contributions in that tax year, and you're not always going to know what your profit share is. If you're a fixed share partner, that's a bit more straightforward, because the chances are most of your profit share, if not all of it, will be fixed. So you'll be told at the start of the year, this is what your profit is. If you know your profit share is going to be 110,000, easy at that stage, you know you need to make a pension contribution of 8,000 so that the gross amount is 10. I'll explain that in a minute. And it keeps you below that threshold. But if you're an equity partner, or if you're a fixed share with an element of discretionary profit share that can be allocated to you at the end, it does get trickier, because your accounting year end doesn't finish until the tax year end. So it's a bit of estimation and trying to work out what your profit share is going to be, and a bit of kind of guesswork around that. But it's really important to do a bit of planning and avoid some of these thresholds. Very quickly, you still pay national insurance. So as an employee, you would have paid Class 2 national insurance, and that would have been at an 8% and then over a certain level at 2%, whereas you pay Class 4 national insurance as a self-employed member, and that's slightly lower actually. It's only 6% and 2%. But the main benefit of this, of becoming a member, is your LLP no longer has to make employer contributions as they did when you were an employee. So quite a saving for the LLP with regards to national insurance contributions. So right, I've now told you what rate you're going to pay your tax at. So when are you going to pay your tax? So we'll look at the timing of tax payments. So I mentioned that you, as a self-employed person, you have 2 times of the year when you pay tax. You pay it in January and you pay it in July. So I'm going to start with a simple example. You've been a partner for a number of years. And we're now going into the tax year ended 5th of April 2027. So when you pay your tax for that tax year, you pay your first payment on account. That POA is payment on account. You make a payment on account towards that tax liability 31st of January 27. So before that tax year ends even finished. But the amount you pay is based on 50% of the previous tax year's liability. And then 6 months later, in the end of July, you pay the second payment on account. So exactly the same amount. It's based on 50% of the previous year's tax liability. So by the 1st of July, if your profit share hasn't changed much, you will have paid pretty much most of your tax by that point. And then when you're doing your tax return, remember I said that tax return will need to be submitted by 31st of January 2028. At that point, you know your full tax liability for the year, and that's when you need to make your balancing payment by. If your income had gone up, your payments on account won't have been enough to pay all of that. So you've got a final balancing amount to pay there. If it was too much, you get a refund. But don't forget, at the same point, you'll make your first payment on account ready for next year. So you've got your balancing payment then, and 50% of that liability will be paid towards the following tax year. Now, if you think about it, in the year that you become self-employed, you're not going to have made any payments on account because you won't have had a self-assessment tax liability in the previous year. So again, for the same tax year, 5th of April 2027, you're not going to make any payments of your tax until the 31st of January 2028. But at that point, you pay the full liability for that tax year and half towards next year's. So that's quite a painful one because you're in effect paying tax for a year and a half all in one go. But the good news is the majority of law firms will operate a tax reserve system. So what this means is they actually withhold an element of your profit and set it aside in a tax reserve. There's a tax reserve for each member. They set that aside for you and they hold on to that money and they make the tax payments on your behalf. So it does take away a lot of the stress and worry each January and July for you as an individual, because you know they've already held back the tax and they are going to pay that directly to the revenue on your behalf. It does make cash flow management quite tricky for law firms, and the July and the January is always their toughest month from a cash flow point of view. But the beauty of the tax reserve system is they're holding back based on the estimate of what they think your tax will be, and they settle that on your behalf. So it does take away a lot of the stress of being self-employed, because that's one of the hardest things, I would say. So hopefully I've kind of explained how the tax works. And it's one of those where you almost need to see the numbers and see the years and apply it to your own scenario and the date you joined and what your law firm's year end is to really kind of understand it. But hopefully you'd be able to go back through those slides and understand how and when you'll be taxed, when the payments are made, etc. So I'm moving on now to look at your investment in the LLP. So you're going to put a capital account in an LLP. So the capital account represents a loan from you as a member to the LLP. And that LLP needs that loan from you because they need to have sufficient working capital to be able to operate. So if you think about how a law firm works, you typically incur expenses. So you pay your staff salary, you buy various assets, you pay the rent on your property or your overheads. You have to pay that far sooner than your clients ever pay you. So if you think about the work a member of staff is doing, there's quite a time lag from when they start working on that and you're paying them their wages to when you can eventually invoice the client, and then the money comes into the bank of the LLP. So the reason a capital account is needed is to fund that kind of time delay and when your clients pay you. But remember, a capital account is always a loan from you. It's your money, but it's your long-term investment into the LLP. So as it's your money, obviously when you retire, it will be repaid to you. It's repayable on retirement. So what a capital account isn't, it's not you buying goodwill from other members. It's not your way of buying a share of the business or buying out other members. You're putting in, let's say 100,000, you're putting that in. You will probably get interest paid to you on that investment. Not all firms do, but generally you'll get interest paid on that. But when you retire, you get your 100,000 back out. What you put in, you get out. It's not an investment that grows in value or it's shares as such. So just remember that it's your kind of long-term loan to the LLP. And there's various decisions around how that capital should be set, and every law firm will have different capital need based on a number of factors. But before I get into that, I would like to just step back a bit and do some accounts. I'm going to pull up a balance sheet of the LLP just so you can, again, I'm going to use this to just help you understand why you need to put capital into the business. So this is a balance sheet. So your first year, you've been a member for a year, you get a set of accounts, and within that set of accounts is the balance sheet of your LLP. Now on this, we've got some tangible assets. So these are the assets that the LLP has had to purchase. They've had to buy computer equipment. They moved to a new office and did some works in there, so they've had to capitalise that. As I said, that gets capitalised and put on the balance sheet. These are the assets, tangible. And then we've got in there unbilled income. So you do work for your clients, you put your time on the clock, you all time record, I'm sure. So it all goes on the clock there, and that builds up as WIP. That's work in progress. That's work's done that hasn't been billed to the client yet. So there's a value to that. So that at that point on this particular LP sits in there at 500,000. You've also got some trade debtors. So this is where you've billed the client for that WIP. You've got to the point where you can bill them, but they haven't yet paid you. So they still owe you 150,000. So there, we've got another 150,000 as an asset due to the LLP. I might get a little bit techie and sound a bit accountancy here, but you then got some prepayments. So you pay for things in advance. You pay for your PI insurance in advance, but we will recognise that over the term of that whole year. So if you pay for a whole 12 months and it runs to the 30th of September, we would put a chunk on the balance sheet and release that next year. So again, that's in effect an asset due to you, and you've got some money in the bank. Nice healthy bank balance there, 200,000. So you've got assets, current assets, so that's your short-term assets that you can hopefully turn to cash quite quickly, of 900. And then you have some creditors. These are people that owe you. This is where you get a little bit of your natural funding from. So the time it takes you to pay your suppliers for your paper stock, your tea and coffee, the time it takes you to pay the revenue, because you've got a time lag in when you have to pay across the VAT, you get a time lag in when you pay PAY, etc. You might have some bank loans in there or some other loans. So those are your creditors. That's who you owe money to. So we then get down to a net current assets, that 900 less the 200 of 700. Then you might have some other long-term loans. You might have within that provision and creditors a bank loan that's due after more than 1 year. That gets shown separately. So we've got a few more amounts that we owe. So the balance sheet of this company shows that it's got total assets of 800,000. Then down the bottom, we show how that is held by you as members. And I will just point this out here because it shows you've got a capital account, current account, tax reserve. And I will explain those in a lot more detail later on. But what I'm trying to get at is you can see on here that you've got assets that you have to fund. You've had to buy the assets. You've had to fund that work in progress and those debtors, but you do get a little bit of funding from your creditors. So this just helps that you kind of put in place what a balance sheet looks like, so I can then explain to you how a law firm might come about working out what that capital is. So I've said that you need to put capital in, But where does that number come from? Who decides how much capital a law firm needs? Now, in most cases, there should hopefully be a bit of a structured formulaic approach to that. And that's helpful because then everyone understands why they need to put a certain amount of capital in. So if we go to the next slide, this is an approach that quite a few law firms might typically make to trying to work out how much capital they need to put in their business. So at the top there, we've had to buy some assets. We've spent 50 grand. We've had to fund our WIP and our debtors and our other prepayments. So we're going to have to fund 700. So we've got a total of 750,000 of assets to fund. Now, I said that we can get some funding from the capital we put in. You also, as a law firm, will get a bit of natural funding from the timing of when you pay people, and you can get some external borrowing. So this is what this formula is doing. It's saying we've got 750,000 to fund. Now we get a little bit of natural funding from when we pay our trade creditors, when we pay our VAT. So we get some natural funding there in this example of 200,000. So we're left to have to try and find another 550,000. So depending on the law firm's appetite for borrowing and debt, they could typically go to the bank based on the balance sheet they've got and go and borrow 175,000. So of that 50,000 they need to fund, they're going to externally fund that with some bank borrowings or a PI loan, and they're going to borrow 175,000. Now, I've mentioned your current account and tax reserves, and I think when I talk about those later, I'll explain them in more detail. But basically, in your current account, that's your undrawn profit at any point. So you're always going to have a balance in there. So you always get a bit of funding from the delay of you drawing your profit out of the business. And also, I talked about when you pay your tax. Now, the firm is holding on to that money to be able to pay your tax, but you actually pay some of your tax after your profit, after you've earned those profits. So again, you get a little bit of natural funding from what's sat in your current account and your tax reserve. So there's another 250,000 there. And then I just put a little bit of an adjustment in there because this is only a snapshot in time and things go up and down. So you could say in this particular law firm, based on the level of its assets, you need capital funding between all the members of about 180,000. So this is a nice kind of formulaic approach to understand why this law firm needs the level of capital that it needs. And what I think is important for you as new members is to understand why you're being asked to put capital in the first place, but also why they're asking you to put a particular amount in. So if we move on to the next slide in here, I'm referring to typical levels of capital account. Now, there aren't really typical levels as such, but I've just put some on there to give you an indication. It just shows that fixed share members tend to have lower levels of capital. And I explained that earlier. And then the equity, depending on the size of the firm and the nature of the firm, obviously larger firms often do need to have slightly higher capital accounts. But there's a number of reasons why you might need differing capital accounts. And you look at one firm and they only need partners to put in 100, whereas another firm, actually, they need 200 per partner. There's a number of factors. Actually, could we go back a slide, Saf, and I can just talk through these. So yeah, so on here, so this law firm, they don't own their property, they lease their property. So they don't have a big outgoing cost for their property. Now, if you had a firm that owned their own freehold property, that number at that top, that 50 would be a lot higher. So suddenly a law firm that owns their own property is going to need more capital because they've got bigger assets to fund. Also, some law firms have a far higher lockup. They have far higher levels of WIP and debtors, and that might be due to the nature of the work they do. So if you've got a firm that does a lot of clinic work, their WIP is going to be much higher than a firm that does resi and maybe just the typical kind of wills and probate, your usual area. So yeah, if you've got a lot of CFA WIP, then you're going to, again, if that 500 is higher, you're going to need more capital in your business. So it depends on the nature of the work you do. Actually, also some firms are just not very good at managing their lockup. Their WIP and their debtors are just higher than they should be. So again, poor WIP and debtor management you need to put more capital in. Also, if a firm is debt adverse, I'd say of most firms we act for, probably 1 in 5 firms don't like to borrow. They don't want to borrow on their balance sheet. So actually there's 175k down there that was being funded by external borrowing. Now, if your firm doesn't have any external borrowing, obviously the partners need to put in more capital. So it's just to give you an idea, there's no right or wrong answer to what the level of capital is, but it's just really, really important that you understand kind of the approach your firm is taking, and why you're being asked for your certain amount of capital. So if we can just go on a couple of slides, Saf, please now. So what levels of capital account? I've talked about these typical levels, and I've talked about how it's driven by the funding model, and I've mentioned that fixed share members tend to have lower levels than equity. So we might ask, why do fixed share members have to have capital? Why do they need to put money in the business? They're getting a fixed share. They're not really getting that reward in the same way that equity members are. We have to put capital in because it helps demonstrate to the revenue that you're self-employed. So the revenue don't really like partners who are on fixed shares and don't really have much control or management rights within the partnership. They think really, actually, they're employees and you've only got this structure because the LLP doesn't want to pay employers' national insurance. Now, that's not the case. Often you've got fixed shares because it's a stepping stone and a way for people to move up to equity members, but the revenue don't see that. So we need to be quite careful in what level of capital is set for a fixed share member. So you can tick the box of the revenue and demonstrate that you're self-employed. So they've got some various rules, which you can go away and read about. They're salaried member rules, and they came in 2014. And there's 3 different conditions, and it's important that you don't meet one of them. And the easiest one not to meet is the one around capital. And the condition is that your capital contribution needs to be greater than 25,000. So that's what we need to comply with to show that we're self-employed. So basically, if you've got a fixed share of 100, you need your capital to be greater than 25% of that, so 25,000. They did bring in some anti-avoidance legislation recently. They're trying to clamp down on these fixed share members. They don't like them. So recently they brought in some anti-avoidance. So what used to happen is you'd have a fixed share of 100 and your capital would be 25,001. And then your fixed share next year might go up to 110. So you put another 2,500 of capital in. And this pattern continues for a number of years. The revenue have said that's anti-avoidance, and if you're doing that, you're only doing it to tick the box in effect, and they'd come along and say, no, don't agree, you're an employee, we're going to charge NI, etc., etc. So it's actually quite important that you set that level of capital from the outset higher than maybe you would have a few years ago. And you might think, why am I being asked to put in 50,000 when my fixed share is only 100? Well, actually, they're probably future-proofing that and looking at what your fixed share could potentially be in a number of years and kind of setting it at 25% of that highest level it could be. If you're never going to get more than 200,000 as a fixed share partner, set it at 50,000. Then you're comfortably within that greater than 25%. So that's just to explain there is a reason fixed share members have to have capital in to demonstrate that they are self-employed, and it's quite important that you think about what that level of capital is. Equity members, it's much more driven by the capital funding model, and often the level of capital an equity members got in is linked to their profit share. So I put on lockstep here. Certain firms might have a lockstep where as an equity member, you've got certain levels of equity, and as you put in more capital to move up a lockstep, your profit share will go up in line with how your capital goes up. So you've got different levels of equity. So that's kind of how the capital is determined, maybe more for the equity members, just to explain why there's some differences in there. So we're nearly at the end of the capital. We've talked about why we need capital. We've talked about how the level's determined, what the difference is between what a fixed share and an equity member might put in. So if we just move on to the next slide, we're going to cover off how you're going to fund that. So yeah, quite scary when the law firm comes along and says, would you like to be a partner? Yes, but you've got to put £50,000 in. Quite possibly you don't have that in your personal savings. Maybe you do, and you can fund it that way. But more commonly, you probably need to go and borrow to be able to put that capital in. Let's go with 50,000, nice round number. So you could either go and personally borrow for that, but quite often you'll find that your LLP main bank will have an arrangement where they're happy to fund partner capital loans, which makes it a little bit easier for you to arrange that loan. As part of that, the LLP will give an undertaking to that bank, and that undertaking basically just means that when you retire as a partner, they will repay the loan to the bank rather than directly to you. So the bank feels more secure they're going to get it. But ultimately, it's really important that you understand that even if that loan is with your LLP bank, that loan is still in your name. It is your liability. If anything was to happen to the LLP, you are still responsible for repaying that loan. That's just to point that one out. Now, if you do need to borrow to put your capital into the business, you can get some tax relief. So there is a good outcome to this, because you're borrowing to make it's a business loan to put capital into your business. You get tax relief on the interest you pay on your loan. So if you pay £1,000 of interest each year and you're a 40% taxpayer, you can get tax relief and reduce your tax liability by £400. So actually, that interest only really costs you £600. And as I said at the start, most firms will pay you interest on the capital you've got in the business. So you'll get charged interest on your loan, but they will also pay you interest on the capital you've got in. So actually, normally similar rates, so you're no worse or no better off. And those will both you get tax relief on the interest you pay, and you have to pay tax on the interest you get. But it pretty much all comes out in the wash. As you become a member and you for a number of years and you're working your way up, if you need to put in further capital at any point, you might do that via retained profits. So you can't do that at the start because you've not been a member and you don't have any profits at that point. But what you might decide to do is, you've got more capital to put in future years. Actually, don't withdraw all your profits each year. Hold back some of that and use that to top up your capital at any point. Less common, you can sometimes see loans between members to enable a new member to put their capital in. As I say, not that common, but I have seen it before, possibly to help short term while someone's arranging their loan to put their capital in, and another member may loan it to them, either on balance sheet, so they just make a transfer between capital accounts, or off balance sheet, and they actually, behind the scenes, personally make a loan to another member to enable them to put their capital in. If they charge interest, again, you'll get tax relief, remember that one. And I'd recommend a loan agreement if you've got a loan between members outside of the LLP. Now, I've put personal mortgages on here because it's quite a clever tax planning point that I'd like to talk you through at this point. Now, might not be so relevant for you when you first become a member, because as I said, generally you've had to go away and borrow to put this capital in. But if you were lucky enough not to have to, and you have been able to do this from personal savings, or further down the line where some of it is from retained profits, if you're ever in a position where you have not had to borrow to put all of your capital into the business, so some of that is capital in the business with no loan against it, but you've got a mortgage, a personal mortgage on your house, you've got personal borrowings, you can't get tax relief on that interest that you pay on your mortgage because that's just your mortgage. But if you do something clever, you possibly can. So let's say you've got 100,000 of capital in the business and you've got no loan against that. You've managed to put that in for personal savings, retained profits, etc. But you've got a mortgage. What your LLP could say to you is, we don't need your capital. I'm going to repay you your 100,000. Repay you 100,000. You go along to your mortgage provider and say, I'd like to pay 100,000 off my mortgage. Pay off your mortgage. Then quite quickly after this, possibly even only a day or two, your LLP comes to you and said, oh, we do need some capital from you. Please, can you put 100K of capital back into the business? You go back to your mortgage provider, draw down that original 100,000 back off your mortgage, use that 100 from your mortgage to put your capital into the business. Now, the interest element on that 100,000 of your mortgage, now get tax relief on that because you've borrowed to put that capital into the business. Now, admin might probably think, oh, that will be a painful process with your mortgage provider, and maybe it will be. But if you think about it, if the numbers are worth doing, actually, I have seen people do this process. You have to go through the physical transactions, you have to make these payments, you have to have clear evidence of the LLP asking for the capital, etc., etc. But it is a clever way to get some tax relief on your mortgage interest. So something to bear in mind for the future, even if not relevant now. It's one of our favourite little tricks. So I've talked about how you're now going to fund your capital account, hopefully various options there, and also for help you thinking about how you might need to fund it in the future as well. So I'm going to move on to just the final bit on the funding side of things. So I mentioned that you have various different balances. You have a capital account, you have a current account, you have a tax reserve. It will be useful if I just quickly summarize these now. So your capital account, that's your long-term funding needed in the LLP. That's the money you've put in the LLP, and that's there long-term. That's there until you retire. It's your money, but it's there. Remember that. Your current account, that's your undrawn profits at any point. That's your money, but you've not yet drawn down on them. When you get your profit share, it's allocated to your current account. You take your monthly drawings and some money set aside for your tax reserve, and you've got to balance that in there. So that's your current account. It's called current because you should be drawing it down quickly. And if the capital account is set at the right balance, you should, by the end of the following year, have always cleared your current account down, in effect to nil. So if you've got a balance on your current account of 50,000 at the end of the year, I'd expect you to be able to take that out over the next 12 months. Maybe you need tranches to help with cash flow, but your current account should be cleared down. Ultimately, you've paid tax on those profits. You want them in your pocket rather than in the LLP. And then you've got your tax reserve. So I touched on this briefly, but just to let you know a bit more about this, this is where when we do the accounts, we estimate your tax on your profit share, and we say that the tax liability on all those profits up to your year end is going to be X. That amount gets pulled out of your current account, set aside in the tax reserve, and the LLP use that to settle your tax each January and each July. Now, we only estimate it at that point because sometimes you haven't provided all of your tax return information, and actually maybe you've made a bigger pension contribution than we were aware you were going to make. Now, if we've slightly under or estimated that tax reserve, you don't win or lose, it just gets tidied up in the next year, and any under or over provisions just flow through your current account next year. But we will have done a pretty good estimate on what needs to be set aside in the tax reserve. And again, that is your money, but it stays in the LLP, and they use that to settle your tax for you. So you've got those three balances. Now, I mentioned in the current account about drawing. So if we go on to the next slide, we're looking at drawing. So as an employee, you were used to getting an a monthly salary, same amount, kind of fell into your bank account each month. Quite easy to manage mortgage payments, etc., etc. So to enable you to manage your personal cash flow, what will happen is you're still going to get some monthly drawings. So each month you're going to receive an amount. Hopefully that's higher than what you used to get as an employee, as a salary, but you're going to get the monthly amount. So, you know, that change from being an employee to a member is hopefully a bit more smooth. Now, for fixed share members, generally that will be worked out so that most of your profits are paid out to you through these monthly payments. So they'll work out what your tax is likely to be, and then work out therefore how much you should get each month. So when you get to the end of the year, you don't really have much left in your current account. You've received it gradually throughout the 12 months, which is quite nice as a fixed share member. With an equity member, it's not necessarily quite as clear cut as that, because you don't know what your profit share is often going to be, depends on how well the business has done. So you will get a monthly amount of drawings, a bit more conservative than what your total amount will be. So often you'll still get a nice monthly amount to survive on, don't worry, but there'll be a bigger chunk left in your current account at the end of that year. And that's the amount that I then said, hopefully your firm will have a sensible capital account balance and a policy on how you're then going to get that out. And it's just quite helpful to understand how your drawings are going to work, and for you to be able to manage that change from being an employee to being a member. So moving on now to the members agreement. So deed of adherence members agreement. So as I say, obviously your employment rights cease as soon as you become a member. All those obligations, all that protection you got by being an employee, that all ceases. So instead, when you become a member, you sign either the members agreement or a deed of adherence to the members agreement. Really important. I shouldn't need to tell a load of lawyers, but really important to read that members agreement. And I don't mean skim it, I mean read it, and make sure you fully understand it, because that members agreement has got all the rights and protections, etc., in it. And I'll talk you through a few key clauses in a minute. Sometimes it's quite helpful to go and take some independent legal or financial advice, so that you know how that members agreement is going to apply to you and what that means, what you're signing up to. But the protection under a members agreement will be quite different to what you had as an employee, and certain personal protections that you may have got won't be applicable. And I know Mike's going to be covering that off for you shortly. So I've just got a few key clauses I wanted to list out for you, because I know our members agreement is huge, and lots of members agreements will be quite long, so it's just quite helpful. So on the next slide, I'm going to just talk you through quite quickly a few of the key clauses that I think when you're picking up your members agreement you need to focus on. So Saf, can you just move us on? Oh, lovely, thank you. Talked quite a lot about capital. So the agreement should clearly set out how much capital each member must contribute, when it must be paid, and what happens if additional capital is needed at any point. As I discussed earlier, the members agreement should set out those capital requirements, not just the initial amount you need to put in, but what the progression steps are. So if it's lockstep, what level of capital is required at each of these steps. A clear capital requirement clause in a members agreement kind of removes any uncertainty and just makes sure that the firm's got predictable working capital, but also that you understand kind of what is expected of you going forward. And yeah, that members agreement should cover that off. Really important one, profit share arrangement. Whether the firm uses lockstep, bit more of a modified lockstep, or kind of a performance-based allocation, the rules around the profit share arrangements must be really transparent, and that would be included in your members agreement. Actual amounts of profit share, or the percentages, they're not going to be in the members agreement, because obviously that changes and you don't rewrite your members agreement every year. But the basis on how those profit share arrangements are arrived at, that will be in there. And also there'll be clarity in that members agreement on how the drawings work, how any bonuses, if applicable, might happen, how that year-end profit allocation is going to work. So again, profit share arrangement clause, really important. Voting rights. So voting rights will determine how all the key decisions are made in the LLP. So the agreement's going to specify which decisions require a simple majority, which super majority, and if there are any, which need unanimous approval. Also, if you've got a firm that's got fixed shares members and equity members, again, the agreement's going to specify how the voting rights might differ between those types of members. Yeah, really clear voting right clause kind of helps avoid those disputes later down the line. Member expulsion, not something you want to think about, but every firm needs a mechanism for expulsion. And the agreement will outline the grounds for that expulsion, kind of the votes that will be required, and actually the financial consequences for that departing member. And that's likely to differ if you're a bad leaver, you've left under bad circumstances, as opposed to, a typical good leaver that's just retiring or moving on to another firm, and everyone is parting in under good ways. So that member expulsion clause is really important to understand, and that will help protect the firm and the individual. Member retirement, feels a bit wrong talking to you about retirement when you're all just starting out as members in a law firm, but even so, really important that you understand how that process will work when you do cease to be a member in this particular firm. So a member retirement clause will cover notice periods, restrictions on maybe the numbers that can retire in any year, how your capital is going to be repaid, any, let's say, post-retirement profit entitlements, if there are any. So all of that will be covered in there. That's really important. Underperformance as a member. This one's probably becoming increasingly important, I would say. And the agreement's going to set out what constitutes underperformance of a member, and what the review and the support process looks like. And then if that member doesn't improve, kind of what actions may follow. And actually a really clear underperformance clause. Just makes the whole process fair. So you want to have a read of that one. Obviously, these are clauses we never hope you need to be referring to during your time, but even so, it's important you understand how they would work. Ability to change a members agreement. Yeah, your firm needs to be able to change its members agreement. You want to make sure that there is a route for changing a members agreement. You don't want your firm to be stuck with outdated governance that's no longer fit for purpose. So review that and see kind of how it can be amended, as in what level of voting is required to make changes to the members agreement and how that's controlled, just so you've got the comfort that it can't be changed too easily, but that it can be changed where needed. And rights to access. So as a member, you might want to actually access various records of the LLP, various financial information. So that will all be covered again in a clause in that as to how you can access and obtain information. So that's just helpful because ultimately as a member, you want to know that you've got access to things, and it's balancing that confidentiality with kind of being able to operate the LLP. So yeah, I just think it's helpful for you to just have a bit of a guide as to what you want to focus on when you're looking at the members agreement, because it's quite daunting. Well, it was to me, but I'm an accountant. I do numbers. I suppose for you, you love all the words. But yeah, just to help you guide you through the members agreement. And then I've only got a couple more slides before I hand over to Mike. I know I've been talking for a while, but these next slides we're covering off tax relief. So these are definitely ones that's really important for you to pay attention to. And they're ones that you want to be thinking about in your first couple of years as a partner, because there's a lot more options when you become a member and you're self-employed, a lot more options around tax planning and making sure you're maximising the tax relief you get. So the first one is pension contributions. Hopefully I'm not going to say too much and steal Mike's thunder here, but as I said, you need to set up your own personal pension scheme. You can't continue to make pension contributions to the scheme that you had through your employer. So talk to someone like Mike, he can assist with that. And just to talk you through how the tax relief works on pension contributions, because it's slightly quirky. So you get two aspects of tax relief when you make your pension contributions. So first, when you make your initial contribution, you get some tax relief at source because the government actually automatically top up what you put in. They put another 20% in. So if you make a pension contribution of £8,000, another £2,000 gets topped up into that. So you made a gross contribution of 10. So we refer to net and gross. So the amount you physically put in is the net amount, that's the 8,000. But the gross contribution is the total that makes it into your pension fund, and that's 10,000. Hopefully Mike will jump in if I say anything wrong. And then secondly, if you're a higher rate or additional rate taxpayer, you then get some further tax relief when we complete your tax return. Because as I said, when we were looking at those tax thresholds, by making a pension contribution, your basic rate and your higher rate thresholds, they all extend by the gross amount of that pension contribution. So sticking with that same amount that I referred to, you've put in 8,000, revenue have topped that up, so you've got a gross contribution of 10. So you've got an extra 10,000 that's actually only going to get taxed at 20% rather than 40%, because that band has moved up. So you've actually got a total saving there of £4,000 on that 8k contribution that you made. So yeah, two aspects to how you get the tax relief. Pensions are really complicated. There's annual allowances. That all starts to get tapered when your income goes over certain levels. You can use previous years' unused allowances, but that's all done in certain orders. Complicated. Talk to the likes of Mike, talk to your tax advisors to understand what allowances you've got. Yeah, and when it comes to making pensions, really, really good tax relief, quite complicated, and definitely seek some advice. Tax relief on domestic running costs. So if you work from home, you can claim some tax relief on your home running costs. And now when I say work from home, most firms have got hybrid working policy, so most people work from home, but you don't necessarily have whole days at home because you're a partner now and you might want to be in the firm with your team. But I'm pretty sure most of you get your laptop out in the evenings, clear down those emails, do the odd bit of work on a weekend. So if you are even doing that level of working from home, then actually you're still entitled to make this claim. And again, you want to talk to your tax advisor just to make sure you're doing enough work from home. But basically, if you do some work from home, you can make a claim. And there's two methods. You can just take the really simple route and you can just claim the standard amount, the HMRC rate. So on there, you can claim 312 per annum. So if you pay tax at 40%, you save £125. Not big numbers, but really simple. You just tell your tax advisor you work from home, you can save £125. Or you can go down a much more detailed route where you can actually do a detailed calculation. And in the next slide, I'll talk you through that. But if you pay interest on your mortgage, it probably is worth doing this detailed calculation. And people can save a good couple of thousand. And I have seen people save even 4,000, 5,000 of tax by doing these detailed claims, depending on your circumstances. But there are some CGT implications. So I will just very quickly say, never say that you use a room 100% of the time, because that affects your ability when you sell your house to fully claim principal private residence. So if we go to the next slide, I've got a little example, and you'll see on here that I've gone for 90%. Never use a room at 100%. So this detailed calculation, which I will go through quite quickly because I'm conscious of time. For this individual, their house has got 6 rooms, excluding their bathroom and kitchen. They've got a home office, and of the time they spend in their home office, of that time, 90% of that time they spend doing work, and then they might spend another 10% of their time in that one room doing some life admin. Living room, sometimes in the evening, they sit there with their laptop on their lap, clearing down their emails. So actually, of the time they're in the living room, they spend 10% of it doing work. Dining room, 20% of their time there doing work. So we can take all of these expenses, we can claim council tax, electricity, your mortgage interest, insurance, and you split that across all 6 rooms. And for each of the rooms that you do any work in, you can claim a proportion of those costs. So you can see in this example down the bottom here, I said total claim for this individual is £2,950. So if they're a higher rate taxpayer, they've saved £1,180. That's a nice contribution to a little holiday, isn't it? So these detailed claims do take a bit more work. You do need to keep a record of when you've been working from home, just so you can justify those percentages, and obviously you need to keep copies of utility bills, etc., etc. But they really can be worthwhile, so I would definitely say that is one to spend a bit of time working on. And we've got a fact sheet and a pro forma calculation you can use to do those calculations. A couple more quick ones I'll just run through. Tax relief on motor vehicles on the next slide there. So if you're using your car for any business business travel, you can either claim your actual expenditure, so all of your insurance, your MOT, all the running costs, and work out how many miles you do as business. You've got to keep a business mileage log, so a bit more complicated. But say you do 50% of all your travel is business related, you can claim tax relief on 50% of your running costs. Again, a bit more admin involved. You've got to keep all those invoices. Or, as most firms do, and actually we do nowadays, you can just continue to claim the standard mileage rate, that 45p, a bit like you did as an employee. And actually, there's often not much in it between those two. But yeah, again, 2 options. Chat to your tax advisor about which one would be the best for you. When you purchase your motor vehicle, it's very rare the LLP purchases your motor vehicle for you. But just one thing to know, if you want to remember, if you do purchase a new vehicle and you do that under an operating lease, you might want to consider whether that operating lease should be in the name of the LLP. Because if it's in the name of the LLP, they can reclaim 50% of the VAT on the maintenance element of those lease payments. So actually, the net cost to you is slightly lower. So again, if you're looking to purchase a vehicle, just have a chat with your tax advisor about whether there's any tax efficient ways around doing that. Home office equipment. Again, if you work from home and you've bought a desk, you've bought a computer to work from at home, again, you can claim some tax relief on the percentage of how much you use that for business. So if you've got a computer at home, you use it 60% for working on and 60% for doing, let your children do their purple maths or whatever it is my little one does on ours, then you can claim 60% of that cost. Done via capital allowances, are slightly complicated, but as long as you tell your tax advisor about it, they'll put it through. And again, you might want to consider actually the LLP buying those assets for you, because then they can recover the VAT and then just recharge it for your drawings. So again, if you once you're a partner, think about these things. If you're buying some equipment at home that you're going to use. And my last little one on here before I hand to Mike is a bit of domestic tax planning. So you remember now, you're getting a profit share. Maybe that profit share means you've crept up into higher rates or additional rate bands that you've never had to pay tax at before. Now, if someone else in your household is paying tax at lower rates, maybe they're not even using their personal allowance, or all their tax, or sorry, all their income is taxed at 20%. Now, if that's the case, you might have some other non-partnership assets that you get income from, for example, rental property or investments. Now, if that's in your name, you're going to have to pay tax on that at 40% or 42% when that goes up a bit, or 45% if your additional rate. Is it worth considering who should be holding those assets? Now, if it's possible to transfer those assets to your spouse who's only paying tax at lower rates, again, that income, you can save some tax on that income. Few things to think about. You might not want to transfer your assets to your other half. And also, when it comes to rentals, it's not as simple as just saying you can have the income. You need to do a Form 17 and formally submit that to the revenue, where you've actually declared a change in the ownership. So again, I'm just trying to give you the basics here and things to think about. Have a chat to your tax advisor. But again, bit of thought around what other income you get and where that should sit in your household. Now, I appreciate I've fired a lot of information at you, but hopefully you've been able to take most of that in, and I'm going to hand over to Mike now to finish us off with some financial planning advice. So over to you. Thank you very much, Mike.
Thanks, Sonia, and good afternoon, everyone. So I'm going to go probably for the next 20 minutes around some of the risks that you may be facing in that movement into becoming a partner. So if I just go to the next slide, I think one of the risks that people might be facing is how their income is protected. Now, some of you may be retaining this benefit. Some of you may be unsure. And some of you may not have this. So I'm just going to do a recap on this and really what it means. But the first takeaway, I think, from this slide is this is the bedrock of any form of protection planning to protect you and to protect your family. So how does this work? Well, how it works is it's an insurance policy that's designed to protect a percentage of your income if you're unable to work. So you select a deferred period, which is an amount of time it's not paid for, usually 6 months, and then it will start to kick in at a percentage of your salary. The premiums are guaranteed, they don't increase, and the payment is guaranteed as well for a specific period of time. So a lot of people kind of run these until age 65 so they can protect their income. Why this is super important, really, is that income protection is the bedrock of protecting you and your family, and it's really like a pack of cards, because if you can't work and you've got no income coming in, the mortgage payments don't stop, the bills don't stop, the education costs don't stop, so everything can literally collapse if that's not in place. So just a message here for everyone to really have a good think about that. Have you got it? If you haven't, you know, we're here to talk to everyone, but it's really, really important that you look at this. For me, this is a number one. If we then jump into the kind of the next slide, really now just to talk about protection upon death and protecting family in this scenario. So I would imagine some of you, again, have retained death in service benefits through some form of group scheme, or maybe you haven't retained that benefit. Again, this is really, really important, because the question you need to ask yourself here is, what would happen to your family if you died? Would they have to move home? Would the children have to change schools if you have children, because private, you know, the income stopped and the funding's not available anymore? Would they have to change their lifestyle if that happened? And do you have kind of enough cover in place? And I think that's a question people need to ask themselves here. And also, would you want to see that happen to your family? So if you are losing benefits here, there are kind of probably two solutions that you can look at that are really cost effective. One of them is called level term assurance. It pays out a set sum, and you set a period of time that you want it for. Maybe it's to when children have finished education. Could be lots of different scenarios. But again, it's guaranteed and it pays out a lump sum. So I insured myself about a year ago to protect my partner. If I died, I chose a sum assured, would be paid out upon my death of £1 million. And the reason I did that is if that 1 million was invested, she could draw an income of 5% from it on an ongoing basis, so 50,000 a year. So that could replace some income, or she could draw on the capital, or she could do whatever she wanted to do. But have a think about that. And I would also say the next life insurance that you can also run, and maybe alongside this, is something called family income benefit. This is a more cost-effective way of protecting your family. It pays out a regular income upon death, again over a selected term or number of years. Really efficient in terms of how much it would cost. And again, you can place that in trust, or you can have it kind of paid out directly to family members. So have a think about what would happen if you died. Do you have enough cover? Is there death in service available? Is your mortgage covered? Is it covered adequately? And how would your family survive if something happened and death occurred? Again, have a really good think about that. Do you have enough in place? So if we then go on to the next slide. So we've talked about kind of loss of benefits in terms of maybe protection, but now what about other things? So kind of want to explore here alternative investments, how you can build up money towards a tax efficient retirement income. I'm going to talk about what's happening in markets, and of course lots is happening in markets, and even today there's been some other big changes that I'll just touch on. And then how to kind of position your assets pre-retirement, and what can you do, and how can you get money invested in the right places, and know how they're performing. So I'll go on to the next slide and I'll start to talk about that. So pensions, as Sonia already alluded to, you're going to lose kind of some of that pension benefit from as being an employee, and you would have some employer contributions, usually adding to yours. So now kind of you're on your own with regards to pensions and what do you do? Right, they're still really, really important and have got a great part to play. Again, Sonia mentioned income thresholds over 100k and pension contributions pulling people back, right? So it's still really, really important. Tax relief at your marginal rate. Sonia's already covered this. You can use carry forward and go back 3 years. It is complicated. So again, get advice if you're trying to make contributions. Any money in pensions is free of income tax and capital gains tax. You can flexibly access that money from age 55, and 25% of the fund will be free of tax. So that's another kind of win-win scenario from taxation planning point of view. Currently, pensions are outside of your estate for inheritance tax purposes until April 2027, and then they're inside. So there's some implications there, and there are some different things that people are doing now, which again we can cover with people on an individual basis if they want to, if they're concerned about that. A lifetime allowance was abolished in 2023, but replaced with 3 other allowances, which I won't touch on now, but still complicated kind of area of advice. And again, as has already been mentioned, if your income is above £200,000 and your adjusted income is above 260,000, there are some complications in terms of how much you can contribute into your pension. So for example, someone earning 360,000, the maximum they could pay into their pension is £10,000 and not the 60,000 kind of maximum that's currently available. So there's some things to really watch out for here. I'm going to come back into pensions later on and just show an example of a client and kind of what we can do and how we can look at assets. But we'll just move on to the next slide at this moment in time. So aside from pensions, what else can you do to start building up assets kind of towards retirement or capital kind of in general? Well, firstly, ISAs are a no-brainer, £20,000 that each person can put in each year, tax-free. the growth is free of tax, and in retirement, the income is free of tax as well. And that's really, really important to start building up these assets alongside pensions and the ability to turn on different taps for income in retirement in a tax efficient manner. Now, we now have ISA millionaires in the UK that can retire, not touch their pensions if they don't want to, or adopt a different strategy. But again, it's a great way of building up money exempt from tax. Once you've exhausted that, probably another couple of alternatives here. Unwrapped investments. So taxable investments, open to capital gains tax. But again, what you can do is if you'd use your ISA allowance for 20,000, you've got say 50,000 in a unwrapped investment. Every year you can put 20,000 into your ISA from it kind of automatically. So you can start to mitigate your tax position and get all of your investments tax-free over time. And with unwrapped investments, you can realize losses as well. The next one quickly is investment bonds. So there are onshore and offshore investment bonds. Offshore isn't anything kind of spooky that you might get alarm bells ringing that it's in the Cayman Islands or anything like that. It's absolutely not. It's in the Isle of Man, it's Jersey, it's Guernsey, it's big insurance companies like Prudential. But you put your money into an offshore bond and you defer tax immediately until such a time that you bring some of that money back into the UK. That allows you to plan effectively. You could have changed your tax status in retirement, so it's really tax efficient. You get gross roll-up, which is growth without any form of tax whatsoever. And you can also in retirement take a tax deferred withdrawal of up to 5% of whatever you invest. So what I'm really highlighting here is there are other investment structures you can use aside from pensions that can really help you plan towards retirement. Again, some of them are slightly more complicated than others, but again, there's lots of things you can do. We'll move on to the next slide. Right, pensions. So with what's going on in the world, which we'll come to in a second, everyone might be saying, well, I might be able to get 3 or 4% on cash, so I'm going to stay in cash. That's the best thing. Cash is king, and it's secure. But is it? So this chart takes you back to kind of 1990. And in the 1990s, which I can remember, interest rates were about 7%, and everyone thought that was great. But this chart is showing you that equities over that time, a £10,000 investment, have grown over 125,000 in that period of time, which was treble the return of cash over that period of time. And bonds, more secure investments, outperform cash twice during that period of time. So sometimes when cash looks attractive long term, kind of it never is. And equities and other types of investments always win over the longer term. We'll just move on to the next slide. This is about markets. You know, there's a mixed outlook. We're cautiously optimistic from where we are. There is a lot happening currently. So US economy is still strong. You know, Iran have threatened today, literally today, an economic war. Oil prices are spiking. Where do you invest your money? US economy is still seen as a stable place, right? People used to think in times of economic trouble, I'm going to invest into gold. If anyone had done that right now, it's a wrong decision. You know, that's going down. That's not seen as a safe haven anymore. But US dollars and large companies in the US now are seen as that safe haven. So the world's changing really, really fast. Inflation's in control in the States, but, you know, let's see. We've got oil prices that are starting to spike even higher than $100 a barrel. And when you hit that kind of thing, there is talk, you know, we've got the Bank of England announcement that interest rates eventually could go back over 4% in the UK because inflation's going to run because of oil prices and all the impacts that has on transportation, etc., etc. I did have it in here. The good news was geopolitical tensions were coming down, and that was to do with tariffs. But of course, they're going up at this moment in time, and we still don't know the fallout that would be. Company earnings in the States in particular are really robust. And a lot of people now are looking towards emerging markets as a safe haven for capital whilst we're going through this kind of uncertainty in markets and everything that that this kind of war is bringing along. So bad news, UK economy is being held back quite significantly, and that's through kind of higher prices, that's through tighter government spending, that's through kind of inflation that we're seeing. So we've got some problems there. Interest rates I've just talked about might go back up. I think political risk we've covered, and then large US tech looks expensive, but actually, you know, it's now being seen as a safer haven. You know, companies like Nvidia and others are now seen as a more stable place for the time being, whilst we're going through this kind of economic turmoil. So we'll go to the next slide. As you're kind of planning towards retirement, you need to think about these. I've put additional risks to retirees, but this is a risk actually for people now. And the first one is longevity risk and outliving your money. You're going to need to build up enough capital to live on when you reach retirement. Inflation is always going to erode the purchasing power of your money. So kind of what do you do there, and how can you position your assets to do so? And for me, this next one, sequence of returns, poor investment returns in retirement. So if any of you on the call now have got old pension schemes, for example, with Royal London's a typical example, which is where our business has an employee pension scheme. It adopts something called lifestyling. So in the last 10 years, you start to go from being in equities to more secure assets, and you end up virtually in cash before you retire. That's going to have a massive effect on your retirement planning if you're not careful. So if you've got existing plans, have a look at them. I'll come on to that in a second. And then make sure you've got enough money in retirement, because if you start withdrawing too much too soon, then there could be a problem. So we'll jump to the next slide. I've got here, investors are their own worst enemy. And, you know, we're in the middle of problems. And on the left-hand side of the screen, you can see equity funds. This is a Standard and Poor top 500 companies in the UK. And what we're seeing here is over 1 year, the S&P had delivered about 20 or just over 25% as a return. But the average investor that invested in the S&P 500 actually made 5.5% less than that fund. And the reason for that is people start to panic, and this is where we are now. I don't know what's happening with my pension fund. I'm getting really scared. What happens if it keeps going down? And people sell. And then they come out in the market bounces really quickly. And then people say, oh, well, I'll put my money back in now. Everything seems okay. But you've missed that uptick in the market. So this is where kind of emotional behavior comes in now. So again, if you're managing your own pension funds or you're getting scared, kind of our role in this is to be kind of a critical friend effectively, and kind of stand sometimes between our clients and mistakes that they might make at the wrong time. And it's the same with fixed income funds on the right hand side. So we'll jump on to the next slide. Again, if you're trying to pick your own funds, you know, and you go Hargreaves Lansdown, Wealth 200, who's the best fund managers right now, you might find some, right? But what this slide is showing you is 34% of top quartile fund managers, so the top people at the time in managing money in 2012 to 2016, 34% are no longer top fund managers, and the returns have waned for lots of different reasons. And then it also shows you on the right hand side that in that same period of time, 57% of top quartile fund managers from 2017 to 2021 did not have a full 5-year track record. So trying to pick star fund managers is a real problem for individual investors. And anyone that invested in Neil Woodford's fund would know that, because they lost all their money. and he's now banned by the Financial Conduct Authority, and he was a star fund manager. So you do have to have a lot of due diligence behind picking funds. So we'll go to the next slide, and I just want to go to to a client scenario. Now the numbers on here don't matter, right? This is about performance, and it's about getting your money in the right places right now for your own financial futures and retirement. So this was a partner of a law firm who had 3 different pensions, 700k, had 6 ISAs, 200,000, and let's have a look on the next slide, kind of what happened. So we started to look at advice here for this person. And the starting point was, well, let's have a look at what you've already got, and let's see how those funds are performing. So for this particular person, from November 2019 to October 24, if you look at that line C, the blue line, this person's investments had performed at 32.45%. And that seems really good and really positive, and it is positive. We then benchmarked it against how we would manage money. So the red line is 39.99%, and the green line, 54.79. We then had a conversation, which you can see on the right-hand side, and I just said, look, you know, there's more than a 3% difference, but if those funds performed with a 3% overperformance to retirement over 10 years for this person, the difference in return was £307,957. So the effect of compounding is massive. And again, you need to be in the right assets now towards retirement. I'll just go on to the next slide quickly, which is my kind of last slide, and then I'll pass back to Sonia. So investing money, as I said, in this moment in time and where we are is extremely difficult. So we operate an all-weather approach to investing. And you can see there are different assets that people should be in at different times to protect and grow money. So rising growth, rising inflation, these kind of small and mid-cap equities or high-yield debt. Rising growth, falling inflation, equities and corporate bonds. And one last one, falling growth, rising inflation, inflation-linked bonds, and high-quality, short-duration debt. So we manage this all-weather approach where we are tactical around moving money at the right times to try and get in the right asset classes to protect and grow money moving forward. That's everything from me. I'll pass back to Sonia to close.
Lovely, thank you, Mike. So I think really it's important for you, from what I've taken away from what Mike said, is to see what protection you've now got as a member, if that will have changed, and if there's anything that you need to get put in place, start speaking to someone, get that put in place quickly to protect you and your family. And also, you know, you've now got the opportunity to start thinking about your own pension, so talk to a financial advisor to help plan where your funds should be, etc., etc. So, you know, we talk about retirement, that might be a long way off for some of you, but it's about starting to plan for it now, isn't it, Mike? So
definitely.
Yeah, if anyone has got any questions, please do shout now. I can't see any questions in the Q&A section, but if anyone is brave enough to put their hand up or just shout out a question or type one in, please do. But if there aren't any questions, give a second. Not looking like there is. That's fine. If anyone does have any questions, they'd rather speak to myself or Mike directly, our contact details are here on this slide, or you can reach out to Saf and she'll put you in touch with us. I'm more than happy to have a conversation with anyone to help explain how things work for you, because I appreciate this is all quite generic, and actually getting into the detail around your particular firm and the impact for you is really helpful. So yeah, just thank you, Mike, for helping today. We will share the slides, and we've also got a new partner guide that we will issue with the slides as well, because that kind of just then enables you to go back and kind of look at the bits that that I've particularly covered today, and kind of check over that yourself and just kind of cement that in your head. But yeah, thank you everyone for joining today. I hope you found it helpful. Oh, lovely. Thank you for the comment, Sarah. Yeah, any questions, do please reach out to us. Thank you very much. Take care. Bye.